Hello, investors. Welcome back to Money Reality with Crystal. I'm super excited to have you all here. Today, we're going to be talking about the consequences of investing in index fund ETF as opposed to actually investing in individual stocks. Before we talk about that, let's look at what is actually an ETF or an index fund. Now, an index fund is simply a fund that tracks an index, and an index is simply a category of stocks in a particular sector, in a particular group. The same with ETF. Now, the difference between an ETF and an index is that an ETF has the same feature of a stock. You can buy and sell ETF. You can receive dividend from an ETF, as opposed to an index fund that you have to wait till the end of the trading period before you invest in it. So that is just it. But then, what are some ETFs that you already know? You know about VOO, you know about QQQ, you know about SPY, all right? These are ETFs that tracks the top 500. VOO is an ETF that tracks the top 500 company in the US markets. We also have ETFs in Nigeria that track the top 30 company in the Nigerian stock market. We have ETFs that tracks insurance. We have ETFs for different sectors, industrials, consumer goods. You get what I mean? Now, what is the benefits? Before we go to the consequences, what is the benefit of investing in ETFs, in index funds, as opposed to actually buying Apple, buying Meta, Dangote Cement? What's the benefit, right? Number one, if you're a beginner investor, this is actually a very safe place for you to start, because you are starting off at a low risk, because you're trying to get your feet wet, trying to understand what the market is all about. So you're getting your feet wet with this, right? By buying an ETF, you are able to spread your money over different companies, right? While your risk is actually very low. So it's a low risk investment. Right? The fees are very low because it's a fund, someone is actually managing it, so you pay a very low management fee to have people help you watch the stocks. And another thing you need to know, that you don't need any effort required, right? Once you are investing, it's like general market where everybody is going to buy something. You just invest in the market. It's like what everybody's using, what everybody's doing, just invest in it, and whatever it turns out, you are still with the majority. That's the thing. It's like general market. That's what I'll just call it. But then the returns are actually very low, actually very average. You've seen like a 7 to 15% return if you invest in this ETF or index fund, as opposed to investing in an individual stock. Now, individual stocks comes with risk, comes with a lot of research. You need to do a lot of research before investing in them, right? You need to also be sure that you've tracked the performance of this stock. You are sure that they are very good company, they have strong fundamentals, and they're also a good stock. These are things you need to do. You have to do research, and then you don't need to pay any fee to anybody, because you're the one doing the research. You're the one managing the stock yourself. Excuse me, right? You're the one managing the stock yourself, and then you need to know that your returns can be exponential. Oh my god, you can see 70%. I'm saying it from my own experience. You can see 70% growth, you can see 46% growth in as little as 7 to 8 months if you invest in this kind of individual stocks that have good fundamentals and they are good stocks over true and true. Now, the benefits is what I just explained. You're going to see very huge returns if you invest right. That means you need to learn how to invest in the stock market. You need to learn what companies actually, you need to understand their business model. You need to understand who their competitors are and what they are making, what's their financial report, what does the financial report actually says. This is you need to note if you're going to be investing in individual stocks. But when you're investing in index fund and ETF, you don't need to concern yourself with none of that. It's none of your business, because wherever the company is going, because you're investing in a lot at once, whatever they do as in general, it doesn't really affect your portfolio that much, right? But if you are young, and you know that you have enough time to actually, you have enough time on your hands, even if you don't have much capital but you are young, I advise you to start picking individual stocks and learn about the stock market on your own, because the stock market is something that is not going anywhere. It's an asset class in the investment world, because companies will always do business. Companies will always borrow money from CBN, always borrow money from Fed reserves, so companies will always be in business, right? And there will always be stocks to trade. So you need to learn how to invest in the stock market. All right, I actually do have a course on that. you can see that in the link. You can see the link in the description below, right? So that's just basically it. And I would advise, like I said, if you are young, you don't really have any dependent on you. By that I mean you don't have any family, you are still a student, you can learn about the stock markets now and start picking individual stocks. But then if you don't have that much capital, you don't have that much time, and you have dependence on you, and looking for maybe cash flow, you can just pick ETFs that are actually paying dividends and stick with that. But just so you know, you won't see as much reward as you will see picking individual stocks, right? So that is all it for the consequences of investing in an index fund as opposed to an individual stocks, right? So let's see you in my next video. Thank you all for watching. Crystal cares. Bye.